Hi, everyone, and welcome to the week ahead. I'm Tony Nash. Today, we're joined by Dan McNamara. Dan is with Pulpo Capital, and he'll be with us talking about commercial real estate. Dan, thanks so much for joining us. Really appreciate this. We've also got Tracy Schuchart. Obviously, Tracy is with Hill Tower Resource Advisors. And we've got McKinley Ross. Mac is a portfolio manager, and he's been with family offices, and he'll be talking to us about inflation and earnings. So, guys, thanks again for taking the time on this Friday afternoon. We've got some key themes this week. Dan's been talking about CRE, kind of CRE versus work from home. And so that'll be an interesting discussion to get into. Tracy, there's been a lot of focus on Asian crude demand, so she'll get into that a little bit with us. And then Mac, we're going to talk about inflation versus earnings and kind of what will the Fed ultimately do. So Dan, you're up first. So again, thanks for joining us. I really appreciate your time. I know there's been a lot going on this week, and you've really informed a lot of kind of my thinking about commercial real estate this week. So one of the big stories out this week is about Salesforce leaving their headquarters in San Francisco. Salesforce is obviously the largest employer in San Francisco, and they're giving up about 1 million square feet in the city center, which already has very low capacity occupancy. I think it's around 33% or something. We also saw Whole Foods leaving their retail space. And San Francisco is a really interesting case study. And you brought this up in several of your tweets this week about, I think you highlighted a story where Union Bank and Wells Fargo Bank have both discounted their retail space by, I think, over 50% and almost 70% respectively for each of those. So I guess San Francisco isn't the only place, of course. Houston's pretty bad. Work from home has hit a lot of industrial centers or commercial centers. And you posted a story about companies wanting people back in the office and about a company paying staffers to actually work back in the office. So there's a lot to think about here. And for those of us who don't really understand commercial real estate, can you help walk us through kind of what some of these drivers are? First of all, what is this happening? How bad is it? And second of all, what are some of the things driving this? Is it primarily work from home or is it other things as well?
Yeah, Tony, thanks for having me. You kind of you hit it on the head there with it started, every city's a little different, right? If you take a step back and we talk, you mentioned Houston briefly. I mean, Houston was having major office issues even prior to COVID. It was overbuilt. We obviously had some overhang from oil and gas and that sector in general. But COVID was kind of the game changer for office space. For the most part, going pre-COVID, commercial real estate had one real sector that we were over retailed for a very long time. Pre-COVID, unfortunately, COVID kind of threw gasoline on that fire and killed some of the regional malls. But in a post-COVID world, the way we kind of started to look at the world now and what was changing and our focus shifted kind of from the issues with being over retailed in the United States and kind of the way we shop is shifting towards e-commerce. We then kind of looked at, okay, well, what is now the themes in this new world? Do we believe that work from home or a hybrid model is here to stay? And, it was difficult to say in 2020. There was a lot of talk, the COVID hit in March of 2020, and there was a lot of talk, everything got shut down, but there's a lot of talk of everyone going back after Labor Day. Labor Day of 2020, which today seems kind of crazy, thinking, where we are with occupancy numbers in office space. And then there was a lot of talk about everyone going back after the holidays in early 21, and then it was Labor Day of 21, and yada yada yada, over and over again. But the one thing that doesn't budge is while occupancy has been up slightly, we seem to have plateaued, and every city's a little different, right? You've got the Austins of the world, they're doing a little bit better. Occupancy is probably hovering around 60%, but some of the other cities we're talking about, specifically like a San Francisco, you're really settling into kind of this 40 to 50% occupancy, which is devastating in the commercial real estate market, because you have to remember that these buildings were underwritten with 90+% occupancy, and commercial real estate is an inherently levered market. So when you get very small drops in occupancy, given the leverage that's in the commercial real estate market, there's very large price drops. So and we're not even talking about occupancy. 50% is devastation, because you're starting to see a few offices trade now. We've seen some in LA where, you're down 50+%. And I think that's just the beginning, because as you sit back here, there's not many people I'm talking to in my space that say, hey, you know what we really think is a great opportunity? Office space right now. So the question is, what happens to this where we're wildly oversupplied in office space, and what happens? And I think that's a tough question to answer.
And is it kind of like the 70s where the downtowns were kind of hollowed out and people moved out to the suburbs and their offices moved out to the suburbs as well? Is it a little bit like that, 70s going into the early 80s?
I think it's city dependent, but yeah, let's just take New York where I am, for an example. You're definitely seeing crime is up. You're seeing obviously less people who are willing or wanting to commute to the office. So yeah, you do get a bit of a 70s feel to it. I think that from a crime perspective, hopefully we don't get fully there. I don't think we're there now. But from a valuation perspective, what we need to take a step back is, for the last 40 years, interest rates have been declining, and interest rates are the most important thing in commercial real estate. So for our loans generally are about 10-year loans. So if you've owned a building, or your family or your company has owned a building for 40 years, you've come to the banks about 4 times, and every single time you come to the bank, you've basically gotten a lower loan, a lower rate on your loan, and you've gotten more proceeds. And now we've completely flipped that on its head. And now you're coming to, whether it's your regional bank or your commercial CMBS lender or your insurance company, whoever's giving you that loan. And not only are they saying you're going to have to pay 300-400 basis points more, but you're going to have to kick in, $25 million of equity to get that same loan that you used to get. So it's definitely, it's an ominous time for the office sector right now.
CI Futures is our subscription platform for global markets and economics. We forecast hundreds of assets across currencies, commodities, equity indices, and economics. We have new forecasts for currencies, commodities, and equity indices every Monday morning. We do new economics forecasts for 50 countries once a month. Within CI Futures, we show you our error rates. So every forecast, every month, we give you the 1 and 3 month error rates for our previous forecasts. We also show you the top correlations and allow you to download charts and data. You can find out more or get a demo on completeintel.com. Thank you. So who becomes the investor? So over the past, say, 10, 20 years, the commercial real estate investors, I would assume those are, say, lower or shorter horizon investors. I don't know if that's a safe thing to say, but I would assume those would be shorter horizon investors. Are we now looking at longer horizon investors, or how is that investor makeup changing?
Well, the investor base in commercial real estate broadly, it's very institutionalized. That has probably changed since the 70s. It has definitely changed since the 70s. Commercial real estate has become much more of an institutional asset class. So I think the pain that's going to be felt, it's broad-based, in pension funds and money managers and all sorts of different pockets, private equity firms, that got very large into commercial real estate. There's talk of, yes, there is dry powder, but the question is, and why I don't think you don't hear anybody talking about really diving into office today, is nobody knows where we're going to end up. It's very, very difficult to figure out where this stops. We're seeing a plateau. Do we continue to climb a little bit? Maybe. I for one never, I don't think we're ever going back to 2019 the ways we work. Just like I don't think that e-commerce is going to slow down on the retail side of things.
Right.
So it does seem like kind of a one-way train here, and I think that we're all going to have to get used to this new paradigm where valuations will have to come down. Losses will be taken, and some of those losses will be taken, in bond form by investors. Some of them will be taken by regional banks. And for the most part, a lot of these loans are non-recourse. So when your equity is wiped out, it's if you own a building and your equity is basically zero, you're going to hand the keys back in most cases because you have no incentive to put any more money into this building anymore.
Well, there was a building in San Francisco, or no, sorry, St. Louis, I think, that was valued at like $400 million 10 years ago and now sold for like $5 million or something? I mean, is
Yeah,
that
I think it's sold for 4 and one AT&T. So
okay?
and it's same that's a great case example. And this building was having issues. AT&T left St. Louis years ago. This was a single tenant building, so to re-tenant this building to a multi-tenant building also would be massively expensive. But also we're talking about downtown St. Louis, where basically the majority of the companies have left due to crime. So this thing, the work from home just kind of officially just threw this thing, into basically it's an obsolete building. It probably needs to be teared down. I don't know. We have had people, throw out crazy ideas on what to do with it, but in the end, you're talking about a building that was worth $300 or $400 million at one point and sold for $4 or $5 million. And there's still nothing going on with it. So I think this is going to be one of those situations where the city of St. Louis is going to need to step in here, because they don't want this huge, massive empty building sitting there in downtown St. Louis.
Right. It's interesting. Like when people think, their house price can't really decline that much, or their stocks can't go to zero. That's an amazing case study of, a building that was once worth almost $500 million is now worth.
It was in a 2007 Bear Stearns CMBS private label deal, and it took over 100% severity, meaning given the fees that what happens is when these things default, they sit in special servicing in CMBS and fees accrue. And, so even though it did sell for something, managing this property for 3 years, this vacant property, which was what the special servicer did, and, paying the taxes and all these other things, it sold, it lost more money than the loan was even, for. So it's kind of crazy.
Well,
so you had it Sticks, Bear and Fuller in St. Louis as well.
Sorry, Tracy.
Didn't we see that at Sticks, Bear and Fuller as well when they collapsed?
Yep. Yeah, no. But I would say this one AT&T center is going to set a record. I mean, this is just, it's, it's a bit of a bygone past too. You have a massive tenant who can take such a big space and then they leave the city and the city just doesn't know what to do with it. And it just
sounds
collapses.
like Salesforce. Right.
And I had one more question. Sorry, Tony.
Yeah.
What are you seeing in Chicago right now? Because I've lived there for a very long time. We have this Nordstrom problem. What is your kind of view on what's going on there, especially at Miracle Mile?
Yeah, Miracle Mile's a mess. I was talking about that with an investor yesterday, actually. Overall, Chicago, outside of San Francisco, I would say Chicago is probably number 2 on our cities to avoid list. I mean, it just seems. I mean, when you see Citadel, which was based in Chicago, leave that city, that is an awful sign. That is like the final nail on the coffin. I mean, they were Chicago for many, many years. So for me, Chicago's almost uninvestable right now. There's just a complete fleeing from Chicago. And I don't know when it actually stops. And I don't know if it does stop, right? You've seen, 2 of the 4 of us are sitting in South Florida right now. Unfortunately, not me. But that's probably the only place where office is actually investable right now. And I say that not because there won't be opportunities down the road in other cities. We haven't quantified when this stops. It's going to be painful. And there's 99.9% of the commercial real estate market, they all want to talk up their books because everybody's long. And so that's why I think the information actually coming out, and when you hear someone actually speaking the truth, it hurts, because nobody wants commercial real estate prices to go down. I think people peg me as a bear, but in general, I'm looking at the data and just speaking the truth. It's not fun for me either, because it's a lot easier to make money being long CMBS than it is shorting CMBS. It really is. I would have a lot less gray hairs if I could just buy CMBS and play golf. But unfortunately, we're not in a market for that right now. But it is a wildly interesting market. And it's a good credit pickers market, long and short.
Great. Dan, you mentioned something when you were talking about St. Louis, and I'm curious about that. You said this, the city of St. Louis may have to get involved and so on and so forth. So for these cities like San Francisco, St. Louis, Chicago, how do they derive taxes from commercial real estate? Because it almost seems like this circle of doom, where the workers flee, the buildings are vacant, the commercial real estate investors are stuck, the value goes down. Does that also affect the tax base and then the way cities raise money, and then they don't have the ability to even service this stuff? Is it this kind of declining vicious circle?
Yeah, and there's been some stories out, and I've read one maybe a month ago about New York City, and the percentage of New York City's budget that comes from commercial real estate taxes is very large, and it's based on the valuations of the buildings, right? So as valuations drop, even if people can pay, you're paying less in real estate taxes. So these budgets in the city, they've relied so much on these rising asset prices that there's going to need to be cutbacks, because obviously valuations are down dramatically. So even if the sponsors that can afford to pay, they're going to be paying less, and there's going to be plenty that can't afford to pay, and that's going to be an issue. When I said that the city will need to step in with one AT&T, I don't remember off the top of my head. I remember looking at that deal a couple of years ago, but the taxes on that thing, I'm sure, were a couple $1 million a year. I mean, you're talking about a building that just traded for $4 or $5 million. So you're not obviously taxes are dropping dramatically. Just the insurance and the security, that you still have to pay, even though it's a vacant building. Like, there's a lot of expenses that go into commercial real estate. And when you have asset prices that are dropping dramatically, and owners who are stressed because their values are dropping, but their expenses are rising, it's a combination, and for getting really ugly.
Yeah, I remember when COVID started, and I just threw an idea off somebody, and I said, this is going to be really bad for commercial real estate. And a lot of people are like, no, it'll be fine. It's all going to be fine. Everyone's going to go back to work. And it just has not felt right since then.
No, and I think you're absolutely right. And, I think that, even today on Twitter, and someone had jumped into your feed and something I was in, and they had mentioned interest rates and the Fed cutting interest rates. And honestly, I usually don't reply to those things, but I was kind of like, you know what? I hear this too much, that everyone's thinking the Fed can bail us out. First off, Jerome Powell has made it very clear that he's fighting inflation, number one. And now, I'm not saying that if something horrific happens in the economy that he's not going to cut rates, because clearly we will. But if we're cutting rates later this year, it's Armageddon. Something has broken. Yep. So the idea that
something else has broken, because regional banks have already broken.
Interest rates going down is going to help commercial real estate because the Fed's cutting.
No,
we're dealing with a very, very significant recession if the Fed's cutting rates this year. And I hope they don't, because I don't want to see what that releases. I believe, to be honest with you, that there's probably a lot of people that wanted them to pause last month. And if they paused, I think the market would have tanked, because I think eventually people coming around like, well, what do they know?
Right. Exactly. That's pretty ominous. Dan, I know so little about commercial real estate, and I have so many questions. We could talk for a couple hours on this, I think. So thanks for this. It sounds pretty ominous to me, and I'd love to come back in a couple months and just see where things are, if you don't mind. This has been really
absolutely, Tony, anytime.
Great. Okay, so let's move on to Tracy. Tracy, we've seen some activity in Asian crude demand this week. As we started to see Asia become more active, we saw China imports up, and refineries in the region seem to be aggressively buying for June, Thai refineries, Japanese refineries, Chinese refineries, and so on. So what's happening? Are Asian economies really coming back that quickly, or what else is driving this demand?
Well, I think we need to look at a couple of things. After the OPEC cut, right, we saw prices go up $5, now $8 at this point. But what I think we have to take into consideration is, if you're looking at Asian markets, yes, they're buying in anticipation of demand. But we really need to look at it is are they buying because they expect oil prices now to go higher? And we all know China loves lower oil prices, right? So are they just buying now between Russia lower oil prices and, and maybe that spike up really spooked them. And so they're now buying it on the spot market. So I think what we really need to watch is really the data. And I'm not saying that the data is not improving mobility wise. And all the promises that China is talking about on stimulating the economy as far as looking at domestic construction is concerned, yes, all that should be taken into account. However, none of that has actually come to fruition yet. So we just need to be a little bit careful on getting too excited that this is China demands all of a sudden take it off in the month of March and they're buying in June, because there are really a lot of factors involved. And my particular worry is that it's because this spike in prices has caused them to panic buy.
Okay, so what factors do you look at with, say, China, Japan, Southeast Asia? What are you looking at in terms of, say, their economy coming back or them buying or?
Well, I think, I mean, those are three very separate instances. If you look at Japan right now, Japan is basically a fossil fuel importer. They don't produce fossil fuels. So they are interested in energy security. That's why they're having problems with the G7 right now, because they want to include natural gas, coal. Their nuclear plants are 2/3 of their nuclear plants are down right now. They're not looking to really re-engage those plants quickly. That also takes a lot of time. This is a lagging from the Fukushima disaster. So right now, Japan's on, I want to buy everything I possibly can at this point because we rely on fossil fuels. And again, with the G7, they're having a problem right now because they want to include natural gas. The G7 doesn't, et cetera, et cetera. If you look at South Korea demand is definitely increasing, right? Because a lot of production is moving over there. A lot of manufacturing is moving over there as far as like chips are concerned or whatever.
From China?
Yes, and we're
Okay.
seeing that. And we're seeing that. You just saw Samsung. What was it? 2022. We saw Samsung come out of China a little bit, put everything back in Korea. Right.
Yep.
And so, I think that that's growing. Vietnam's growing. Thailand's growing as far as that market's concerned. So we're seeing increase in demand there. If we're looking at China, then again, we have to go look at, are they panic buying because they expect prices to go higher? Are they buying ahead of what they really need at this juncture?
But China has a huge amount in reserves, right? A huge amount of crude already in their SPR, right?
Correct. Well, we can see, yes.
Okay, Tracy, we always hear about China importing crude, but do they actually have domestic onshore production, or is it all offshore South China Sea?
It's all offshore. They're huge offshore and they're expanding.
Okay, so there are reserves onshore though, right?
There are reserves onshore and offshore, absolutely, and underground, which is why we don't really know the extent to what their reserves are. We definitely know that they're a lot more than the US has.
Okay, and how much of a factor does India play? Because I know there's been a lot of talk about them buying Russian crude, as everyone has, but for some reason it's notable when India does it. So how much of a factor is India in overall Asian crude demand?
Well, I think India is looking at their neighbor Pakistan that can't even afford to import natural gas, right? And is thinking, oh my God, I need to buy as much as I can. When we've got Russian crude oil below $60. It's a little bit above now, but below $60, and the rest of the world is, at $80. So, it's every country for themselves when you're in an energy crisis. It doesn't really matter. And the US pretty much gave them a go ahead, because when the US, we just saw the US go visit India, and basically they said, as long as you keep it below the price cap,
right?
Okay, buy whatever you want.
Right. I feel like on some level, global economies still haven't moved beyond the hoarding mentality that we all developed in 2020. It just seems that way, especially with commodities. People just, when the prices hit a certain point, below that point, they hoard. and just stock it. Are we still there?
Yes, I mean, I think, the natural gas spike in summer of 2022 freaked every country out,
Mhm.
for lack of a better word.
Right.
And so every country went, oh my God,
Right.
especially for a country like Japan, that is the largest importer of natural gas in the world. And
Right.
so, to them, when, prices spiked 85% over where they are today, that scares people. And
Yeah.
people are like, oh my God, what do? We
Should,
we
yeah.
need to start hoarding. And especially when you have the West saying, we want to cut natural gas and oil, right? And you have all these Western banks saying, we're not going to fund these projects anymore. Everybody's, we're seeing decline in shale. And so that means supply is coming down globally, and demand is still exponentially going up.
Hmm. But it's going up where? Is Asia pretty much always that market where it's growing pretty fast, or Europe's not really growing that fast?
I think it's no, Europe's not at all. US is steady. We've always been the largest consumer in the entire world, at least for the last 10, 20 years.
Right.
Europe's not, because they're telling people not to consume energy.
Right.
And then we're seeing manufacturing go to China because they don't have to cut back on their energy consumption, but I digress.
If Ukraine, if that were to stop, let's say by July, how would that impact global energy prices?
I actually think that we would see Europe go back to buying cheap Russian natural gas piped in, to be honest. And that has nothing to do with anything else. Put your feelings aside about Putin. He's a criminal. We all know that. But it's a matter of energy security. It's a matter of they're losing manufacturing, especially Germany, because manufacturing is Germany, right? And so we're already seeing companies like BASF, Mercedes move to China because prices are too expensive there. And you have to realize that even though energy prices have come down, or natural gas prices have come down from the peak at June, July of 2022, that summer, they're still, by historical norms, twice as high.
Yeah.
This is still affecting businesses, and this is still affecting consumers.
So we could see, if things were settled, we could see energy prices decline pretty dramatically. Continue to decline.
I think that we could see, Europe, or I think we could, yes, Europe kind of go back a little bit to piping in more cheap Russian natural gas. And that also has to do with the fact that they haven't signed many long-term contracts, because they're still at that mindset that by 2030, we're getting rid of fossil fuels altogether.
So they want the optionality.
Right. So
2030 is right.
So they're literally buying on the spot market, which is a lot higher. And the problem is that if we get to a point where, they were very lucky that weather was great this winter, and they had, people stopped using as much, they got their usage down. And that was all fine and dandy. But if the summer is really hot and we start to see, we need more energy for air conditioning, if next winter is horrible, that can put them in a very bad situation, because that would put them fighting for spot cargoes with Asia. Because Asia, everything's being diverted to Asia right now because they're paying more money. So, that could put a squeeze on energy prices in general, particularly in the EU.
Yeah, Europe saw that with Qatari national gas like 6-9 months ago, right? Where they were squeezed out of the market. They tried to get cargoes from Qatar, and they
said no. And so Qatar eventually said, all right, we'll give you cargoes, but you have to
cost you.
But you have to give us a long-term contract. And Germany was like, okay.
Okay, very good. All right, Tracy, thank you for that. Mac, good afternoon. Thanks for coming on today. Hey, I want to talk about inflation and earnings. We saw headline CPI come down a bit this week, but core was up. So, of course, the Fed has said they're looking at core, and that's their that's their touchstone, at least in that area. We don't seem to have the makings of a Fed pause or a pivot just yet. I did a quick survey on Wednesday after CPI came out, before bank earnings came out on Friday, regarding a likely Fed action for the May 3rd announcement. Overwhelmingly, at the time, people told me a 25 basis point rise. So only 288 votes, but still, it's pretty resounding result for me. On Friday morning, we saw some pretty positive bank earnings, with JP Morgan giving a huge relief, largely based on net interest income. And so I think people breathed a real sigh of relief around the health of the systemically important banks. So that's good. But with consumer strength, with industrial production numbers, which came out today, which were pretty positive, and so on, does this reinforce the case for a 25 basis point rise in early May? Or do you think people are still on the fence about a pause or a pivot?
So just looking at the Fed futures market and what the market is looking at, it appears that as of an hour ago, you have a 78% chance of a May 25 bips hike, and then there is a 17% chance, up from 0 last week, of then another June move. And I think that what's actually telling is July. Because the highest probability there is no longer no hike, or it was kind of a bit of a 33 blend of what was going on. Today, your highest probability is that you're going to have a hike at one of those two meetings, and now you have an actual chance in being priced in of 2 hikes at each meeting recurring. And also the odds of rate cuts in the back of the year are falling. So, let's just take a look at what happened since March. Basically, you had a bunch of people saying the Fed should pause or cut based on the SVB and Credit Suisse fiasco. And then the Fed decided to go ahead with 25 bips at the March meeting. And, that's very telling. Unless you get another systemic shock, they are not going to pause, and they're certainly not going to cut, at least in the short term. So, in March, they enacted that 700 billion in a one-time injection to basically backstop the banks. And while the Fed is seeing lending amounts drop off considerably, and that should cool things off, that takes time. And in the short term, they're really not equipped to fight that type of liquidity injection with anything else than increasing QT, which I don't know how they're going to justify doing that. So they're going to have to go with 25 bips in May, unless there's some size.
There's been a lot of talk over the past month or so where people have said, the Fed just doesn't understand the impact of lags. They keep raising these interest rates, they keep making these policy changes, but they just don't understand the impact of lag. So SVB blows up, Credit Suisse blows up, corporate real estate blows up, other things. And these guys are just too dumb to understand lags. What do you think about that?
I think it's best to understand that, the Fed isn't that slow. They've come out and said that they know that OER, their metric for rents, does in fact lag.
Mhm.
I think they're very aware that each rate hike takes around 9 months to reach the actual consumer. And, look, at the short term, from a market's perspective, you could say that things are good because they've had that liquidity injection, and a 25 bips hike is not the worst thing in the world, because net it's going to take a while to actually get into the economy. But there are, when you look at inflation, there are lagging things that are on both sides. So, for example, everybody knows that OER is a lagging indicator. And that's why the Fed has said that they know that it's a lagging indicator. That way the market knows that they're aware. And you know, we're facing pretty easy comps for CPI to cool off. And that's why the Fed has been so adamant about super core inflation. That's their favorite metric. And much like core PCE was their favorite metric for years in the prior cycle, they were very hung up on it. Once you see a Fed get very interested in one particular metric, you can know that they're going to stay on that metric very much so. So if you look at lags, you say, okay, well, gas and food prices are coming down. And the assumption is that they're going to continue to drop. But if you look at gasoline futures on the front end, they're up 27% year to date and 37% off the lows. And they're their highest since September of 2022. I don't know how long that's going to take to hit pricing at the pump. And you've seen that it has actually increased a little bit over the past few weeks. But when these metrics were taken, they were around the lows. So if you do have an uptick in food and gas prices, then it could ruin the entire narrative of inflation coming down.
Yeah. So
and
Dan,
now, you're benefiting from easy comps. And I think everybody kind of knows that. And it's more about, will the Fed be able to cut rates? And if so, will it be for a reason that is not systemic risk?
Yep. I think that's a great point. Dan, in real estate, you know, Mac just said it takes 9 months for Fed policy to, you know, flow through to consumers. Do you find it takes 9 months in real estate, or does it happen quicker than that?
I mean, in some cases, it's a little bit quicker, only because, you know, there's without no doubt a lag. I mean, commercial real estate is a very slow moving market. It operates at its own speed, and most of that's due to the length of leases in certain sectors. But yeah, you know, the fact that, you know, we have a floating rate market, for example, I think that's probably the easiest way to kind of use this as an example. Well, when the Fed raises rates 25 basis points, everyone that has a floating rate mortgage in commercial real estate, their rate next month when they go to pay their mortgage is 25 basis points higher. So that right there, you know, that hurts. And you know, there's a lot of pain in the floating rate market right now.
How much of commercial real estate is floating rates? Just
the majority of it is fixed rate. It is. But what happened was, you know, what's happened over the years actually is that the floating rate market kind of started to blossom. People were getting higher LTVs. Shadow lenders were actually really pushing the floating rate market more than your traditional banks. Your traditional banks are more likely to give you a fixed rate 10-year loan. So it's grown. It's still the majority of it's fixed rate, but you know, there's multiple issues there in the floating rate market right now.
Interesting. Okay, Tracy, when we see so crude topped out in July like 130 or something like that, right? So you're on mute. And Mac talked about base effects. So once we see crude past that, say, July high, is it possible we start to see kind of deflationary or disinflationary moves in crude on base effects? I'm just not sure what to expect there.
Sorry, you're cutting out a little bit. I don't think that, look, I think that we're at the beginning of a commodity super cycle. I think metals are next. But, you know, I don't think that necessarily means oil has to go to 130, 140, 200 again at all, by any means. Okay. I think it's higher for longer, right? And higher input costs for mining in general, which is fossil fuels, is going to fuel that next leg up in that. Aside from, I mean, to get into the whole metals thing, so we need a whole nother episode for. But you know, higher for longer does not mean we spike to what, you know, everybody's like, are we going to spike it? And, you know, probably not. You know why? This is exactly why they're still letting Russian crude on the oil on the market. Is because the West knows that if they literally cut them off, which they could by, well, not entirely, but they definitely could put the squeeze on them with secondary sanctions like we've done with Iran, etc. But we haven't, because the West knows that this will put a squeeze on energy. This will cause energy prices to spike again. This is politically horrible for all of these nations, and nobody wants to see this happening, especially the United States in front of an election year. So that's just not going to happen. And so we just have to keep this in mind, that even though energy prices may not spike higher, it's still higher for longer, which puts a strain on everything that involves fossil fuels.
Okay, very good. Thank you. So Mac, so as we see those base effects roll off in August of this year, what message do you think that Fed sends to markets if we see CPI spike up again? Because a lot of those base prices came down in August, September of 22. Do you think there could be a fear of, say, a third inflationary spike and people freak out again, or do you think people will take it in stride?
I don't know if the market would necessarily front run that type of change. I think that the focus is probably going to be, if inflation does continue to come down due to the easy comps, I think that you're probably going to have a bit of a focus on systemic risk and GDP getting weaker, and those lending contractions ending up as a bad thing for the overall economy. That said, if the Fed does in fact pause, and if they end up actually cutting rates like the market thinks in Q3 or Q4, while inflation does have a bit of a jump later on in the year due to those base effects, I would assume that it wouldn't be the best thing for overall markets, because you would have the market just price in more rate hikes down the curve. So you would have, probably a 5-year, 10-year, 20, 30, they would probably see higher rates priced in over there. So you would have a steepening yield curve, which wouldn't be the best thing for mega cap equities, which are kind of viewed as a safe haven in this type of situation. I don't think that the Fed wants to see any sort of jump in inflation at the end of, in Q3 or Q4. I think that they would love to see it just go straight down. But, if there's systemic risk and they're forced to pause, I'm not sure if it would, cause the 10-year yield to collapse to 2%. And I think that the most dangerous assumption right now, and it might not be an assumption that you have to worry about today, is that inflation is going to drop all the way to 2% and then stay there. Because I don't know if it actually will. And if it drops to 3%, that might be viewed as fine. We can,
It's not a victory.
Yeah, but it's not a total victory. And if it stays there is a big question.
Right.
So it's tough to say. I would say that, for the short term, equities are kind of I'm an equities person, commodities as well. I would have to say that those markets are probably sitting pretty in the next few months, but later on in the year, you're going to have some tough questions. And I don't know if the market is going to necessarily front run that type of concern. If inflation is coming down, it'll be the soft landing narrative.
So do you expect chopping Q3 on some of those mixed results?
Yes, I would say the big worry is probably going to be the second half of the year, which is ironically when everybody is starting to price in a rebound. I don't know. The earnings are going to be very interesting, and if there's systemic risks, then that entire forecast might come off the table. So we're going to have to take it in stride.
Yep. So our expectation in Complete Intelligence is for really deteriorated GDP in Q2 and Q3 on tight credit conditions. And it's going to be rough. We don't think we'll get into a recession, at least at this point. We don't think we'll be in a recession in those quarters, but we do think that economic growth will really cut back on credit conditions and other things. So, hey guys, I just want to thank you for a great show. I want to thank you for your time, and I want to just wish you all a great week ahead. Thank you so much.